Hey everyone, welcome back. In my last video, I discussed the crucial role of reading in building a solid value investing foundation. I also suggested books that can get you started even if you have zero experience in investing. If you haven't watched that video yet, I encourage you to check it out. Among the books I mentioned was The Intelligent Investor, a book Warren Buffett calls by far the best book on investing ever written. It's often regarded as the religious equivalent of the Bible, Quran, or Gita in the investing world. Today, I want to share my personal journey with this remarkable book, and at the end, I will highlight the three most important lessons I learned from it. These lessons are timeless and form the cornerstone of value investing. So, stay till then and let's dive in. When I first read Warren Buffett's endorsement of The Intelligent Investor, I knew I had to read it. But the Amazon reviews made it clear. This wasn't going to be a light read. As a beginner, I didn't want to get discouraged. But like I mentioned in my last video, after reading the summary in Warren Buffett's 3 favorite books, A Guide to the Intelligent Investor, Security Analysis, and The Wealth of Nations, I felt more confident. When I finally began reading, it was fascinating, yet slow going. Coming from a software engineering background, this world of investing was completely new to me. I had to pause frequently to Google terms like bonds, assets, liabilities, net asset value, and so on. Despite the challenges, I was determined to finish it, and after 1.5 months of dedicated effort, I did. At that time, I thought I understood about 50% of the material, but later realized my comprehension was closer to 25. Undeterred, I reread the book 6 months later. After going through other classics like Rule Number 1 by Phil Town, The Dhandho Investor by Mohnish Pabrai, and One Up on Wall Street by Peter Lynch. This time, my comprehension improved significantly. But I still felt I had more to learn. Over the next 2 years, I read around 40 books on value investing, behavioral finance, and psychology. When I returned to The Intelligent Investor, the difference this time was night and day. I finished it in a week and felt like I finally understood 80% of the content. As of today, I have read this book a total of 4 times, 3 times in the last 5 years, and the 4th time right now as I prepare this video for you. The process taught me that consistent effort and exposure compound over time, much like the principles of investing themselves. Having shared my journey, I encourage you to read The Intelligent Investor yourself. To make it easier, now I want to share 3 key takeaways from this incredible book that I believe every investor must understand. I strongly believe that if you only focus on these key parts, you will gain a lot, and those are: number 1, difference between investment and speculation from chapter 1. Number 2, concept of Mr. Market from chapter 8. And number 3, concept of margin of safety from chapter 20. Now, let's discuss each of them one by one in turn. Chapter 1 lays the groundwork for understanding what it means to invest rather than speculate or gamble. Graham defines an investment operation as one that, after thorough analysis, promises safety of principal and a satisfactory return. Anything else is speculation. For instance, buying stocks based on trends or hype alone is speculative and risky. Why so? Because this way of buying stocks does not pass the criteria of going through thorough analysis, as well as lacks promise of safety of principal. This distinction is crucial. Investors focus on the long term and the underlying value of the business, while speculators focus on short-term price movements and market trends. Understanding this difference is the bedrock of intelligent investing. To build long-term wealth, focus on investments backed by analysis and sound judgment. Next, in chapter 8, Graham introduces Mr. Market, a metaphor for the stock market's emotional swings. Mr. Market offers to buy or sell your shares daily at varying prices. Sometimes he is overly optimistic and other times overly pessimistic. The key is to recognize that you don't have to act on his offers. Graham emphasizes that the intelligent investor should not be swayed by Mr. Market's moods. Instead, they should use market fluctuations to their own advantage, buying when prices are low and selling when they are high, based on the underlying business value alone. This chapter basically highlights the importance of emotional discipline and contrarian thinking. In chapter 20, Graham introduces the concept of margin of safety, perhaps the most important concept in value investing. Simply explained, the margin of safety is the cushion that protects you from errors in judgment, unforeseen events, or market volatility. It is about making sure you don't overpay and have room for error. Graham argues that investors should only buy stocks when there is a significant difference between the price they pay and the estimated intrinsic value of the business. For example, if a stock's intrinsic value is $100 per share, purchasing it at $70 provides a margin of safety. This principle is the bedrock of risk-averse investing and a key reason Graham's strategies remain timeless. To summarize, the three most important lessons from the intelligent investor are: understanding the distinction between investing and speculation. 2. Leverage Mr. Market's mood swings to your own advantage. And finally, always invest with a margin of safety. These concepts form the foundation of value investing. In my next videos, I will delve deeper into each of these chapters, exploring their concepts in more detail. So make sure you subscribe so you don't miss out. Thanks for watching, and I will see you in the next one.